Hey everyone, with tariffs making headlines again in 2025, many investors are asking the same questions. Should I be worried? Will this tank the stock market? Should I move to cash and wait this out? Ultimately, how is this going to affect me? These are all valid concerns, especially when headlines are loud and markets are shaky. But today I want to give you the clarity that you need. We're going to break down what tariffs actually are, how they impact the stock market, and most importantly, what smart investors should do during times like this. Before we dive in, my name is Ryan Knoll. I'm a certified financial planner and founder of Nav Wealth Partners, a financial planning firm that helps clients nationwide make smart money decisions. Let's jump into the video. So what are tariffs really? A tariff is just a tax on imported goods. It's applied when a product crosses a border. And the payer of this tariff is typically the importer of that good. And that importer can retain the increased cost themselves or pass it on to the consumer or you and me in the form of higher prices. And governments typically will use tariffs for a few reasons. The first is to protect domestic industries from foreign competition by making imported goods more expensive. You saw this in South Korea many years ago as Hyundai Motors was starting up. The country successfully used tariffs to decrease competition and build a big, well-known global auto brand from this. It was used less successfully in Argentina, which is still feeling the ramifications of high tariffs and a low value currency that they're still seeing today. Other countries will use tariffs to punish or retaliate against countries engaging in unfair trade practices. Or third, they'll use them as a negotiation tool in trade talks, putting pressure on other countries to revise agreements or policy. And in theory, tariffs are designed to create fair trading environments to promote domestic economic growth. But in practice, the story is a bit more complicated. Tariffs often lead to higher prices for consumers, especially for goods that aren't easily produced domestically. Think about electronics, raw materials, vehicles, and even groceries. That's why we import a lot of avocados from Mexico, because they're not really easily able to be grown here in the United States because we don't have the right temperatures and climate that are conducive for avocado growth. So that's why you'll see some groceries being imported over the border from our neighboring countries. And because of this, costs can rise up quickly when tariffs go up. They also create friction with global trade partners, leading to retaliatory tariffs or trade wars, which can slow economic growth across the board. And that's kind of what we're starting to see play out right now. And the biggest issue for investors is uncertainty. When tariffs are proposed, adjusted, or threatened, companies and investors are left guessing about costs, supply chains, and ultimately profitability. That uncertainty causes market volatility and often sharp, very pronounced pullbacks, whether or not the actual tariff impact turns out to be severe. It's not just about the tariff itself, it's about the ripple effects, how businesses respond, how customers adjust, and how global supply chains get reshuffled. All of this creates a fog of unknowns. And if there's one thing the market hates, it's uncertainty.
All right, so what we're going to do now is we're going to talk a little bit about what free trade might look like and how a country that can fulfill its own demand for a certain product would operate, how multiple countries who engage in a free trade agreement, how they might operate, and how countries who have a trade agreement but are now being imposed a tariff, what the economic impacts of that tariff is. So what we're going to start with is the one country example. So we're going to say here that we're going to draw a nice little Y and X axis. We're going to say this country sells corn. And we're going to say it's one country and they have no trade. And what the Y-axis will show us is price. What the X-axis shows us is quantity. And at different levels of price, suppliers are willing to supply a certain quantity, and buyers are going to demand a certain quality of the or quantity of the product. So we're going to draw our supply curve as blue here. And we're going to say that this is the supply curve. And our demand curve is going to be in red. And we're going to draw our demand curve here. So as you see, as price goes up, suppliers are willing to supply more goods, or more corn in this instance. And as price goes down, buyers, or you and me, we're going to demand more of that good because it's at a cheaper price. So where these two intersect, this is the equilibrium point. And what the equilibrium point says is that this is our optimal quantity at this given price, and this is the given price, or the optimal price. And what this shows us here is the total economic surplus, which is kind of what I'm tracing here in green. This is a total economic surplus of this one country with no trading environment. And to take it a step further, we want to know what's the surplus to the consumer and what's the surplus to the producer. So in this instance, they're equal. So the consumer surplus is this yellow shaded area here. And the producer surplus, I'm going to shade in pink. So all the producer surpluses, and again, that's the pink area, is the area below the optimal price but above the supply curve. And for the consumer surplus, it's the area below the demand curve but above the optimal price. And this is how a country that has just itself relying just on itself would meet the demand for the corn market in this given country. So that's going to set the stage for what the next two scenarios are going to build out. But I just want to make sure that we have a solid foundation because this will help make more sense. The idea here is to optimize the total economic surplus. Whether you're a producer or consumer, we want the economic surplus to be greater because that means there's more value to be had. So when we start imposing tariffs, we're going to start seeing the economic surplus shrink, and it might create more value for producers versus consumers or vice versa, depending on the amount of the tariff and what exactly is happening in that given trade agreement. Okay, so now what you see here is the supply and demand curve, which is near identical. They're not drawn completely to scale here, but it's near identical to what it was in the last example. The big difference here is now we're in an environment where this isn't just one country relying on itself to meet the demand of one product. We're actually engaging in free trade. And you'll see the free trade has lowered the price below the equilibrium or the Q star from our last example. So the world price here is roughly $15 for, a pound of corn, which may or may not be realistic, but for the sake of the example, we're going to say that's spot on to what the price of corn is today. So what you see here is we have new quantities demanded and quantities supplied. So the quantities supplied at the world price, we're going to denote that as quantity supplied world price, is what the domestic suppliers are supplying for the corn market in this country. But because it's lower than what the equilibrium price is, there's fewer suppliers willing to supply at this lower price. But on the flip side, because price is lower, we're going to have a new quantity demanded at the world price. And that's what's going to be, that demand is going to be met by what we're importing from the country. So there's no tariff from other countries. So there's no tariffs here, and we're importing goods to meet this demand at the lower price point. So the big thing here is how does this affect consumer and producer surplus? So on the consumer side, you see that the yellow shaded region has grown significantly from where we were in the one country meeting demand by itself example. So we have more economic surplus there, but we'll see that the producer surplus is this little shaded pink area down here, and it's much, much smaller than what it was before. But overall, what's happening is we have much bigger, much more economic surplus due to the free trade agreement that we have amongst other countries. So this is the idea behind free trade. This is how you create more value or more economic surplus for individuals by making goods more readily available at lower price points in a domestic arena. So while this might not help producers domestically, it's helping producers abroad because there's more demand for their products. And it's also helping consumers domestically because it's saving them money versus what they would be doing at the if just their country was meeting demand at the equilibrium price point. And that gives them more resources to then allocate more dollars elsewhere within the economy. So this is the idea behind free trade. This is why free trade is good. If there is one main takeaway here, this increases the overall economic surplus, or that there's more slices to the pie here, and the pie is growing a little bit from the consumer side, where domestic producers may not be as well off, but typically we want to look at it from the consumer lens. Okay, so now what's going on? This is the same country now imposing a tariff on the importing of corn into their economy. So you'll see here that the world price, which is that green bar across the x-axis, there roughly at the $15 price point on the y-axis. Now we're imposing a $10 tariff. So you'll see the tariff price is actually higher than the world price, which is the whole idea behind tariffs. Is we want to charge a tax to the producers to the producers who are importing the goods, or the companies that are importing the goods across the border. So what does that do? Well, looking at it from the consumer demand side, we have less demand because price is higher. So this is the quantity demanded at the tariff price. But because price is higher, we have more domestic suppliers willing to enter the market. So you'll see the quantity supplied at the tariff price is actually higher. So, what's happening here from the producer and consumer surplus standpoint? Well, the consumer standpoint is still the area that's going to be above the tariff price but below the demand curve. So, it's still a relatively large region, smaller than what it was in the last example. And the producer surplus is going to be the area below the tariff price, but above the supply curve. So we'll see here it's a little bit larger. Now, it's a little bit larger because domestically at the higher price point, there might be more suppliers or producers willing to meet the demand of the consumer at the higher price point. So the area here, and I'm going to change my color here, this is what we're importing. In other words, that's what, and actually it stretches all the way over to here, but that's what we're producers outside of our country are willing to import to meet the demand. Now, with that said, there's a couple of things that are happening here that aren't noted on the screen. So the first thing is this area right here, this square, which is the area between the world price and the world price plus the tariff and the difference between the spread of the quantity supplied and the quantity demanded. Now, this is going to be the tax revenue from the imported goods. So that's what the government's getting. So it's tax revenue. So that's money that goes to the government. That's not producer surplus. That's not consumer surplus. Essentially, it's value that could have been had by one or the other that is now being taken by the government. But the big takeaway here, and I'm going to shade this in black because this is essentially what this is a black hole. These areas here, these are deadweight losses. This is value that is not had any longer by anyone because we're not meeting the demand at the lower price point and there's not suppliers willing to supply at the price point with plus the tariff. So really the only benefactor here is the government. They're getting more tax revenue, which is the idea behind the tariffs right now. The big loser here is the consumer. We saw the consumer surplus drastically reduce from where it was in an environment where we had free trade or low tariff trade. And a slight winner here, because they made out better than what they had with free trade, is the domestic producers, because this pink shaded area here is a little bit larger than what it was in the previous example. But total economic surplus, and again, I'll trace that in green to keep it consistent with the first example, is in green, not red, is this area right here, which is still large, not as large as it was in the environment where we had one country meeting the demand for itself. Certainly not as large as it was in the free trade environment, but it's still this portion here, which makes up the producer and consumer surplus. So you'll see the tariffs here are basically the main takeaway I want you to have here are these areas right here, the deadweight losses. That's value that could be had under a free trade agreement that's no longer had, and then and then there's tax revenue that the government gets that's no longer going into the pockets of the producers or the consumers, which you could argue is good, bad, or indifferent depending on what the government decides to use that newly found revenue for. So this is why tariffs draw back value from the economy. And this is what we're seeing happen with some of the things that were implemented last week.
So before we go any further, I wanted to remind you to subscribe to this channel, especially if you like my artwork in that last section, or if you just find the content valuable overall. Let's jump back into the video now. So why do markets react so sharply every time tariffs are announced? So anytime a tariff is announced or even teased, markets typically sell off. Why? Because investors worry about slower growth, reduced trade, and shrinking profit margins for companies who rely on global supply chains. So let's break this down. When tariffs go up, it raises the cost of doing business for companies that import materials or products. That could mean lower earnings, and markets are always forward-looking. Even just the possibility of future tariff changes can send analysts back to their spreadsheets, cutting profit estimates, triggering more volatility. It's also about sentiment. Markets move not just on reality, but on perception. If CEOs, investors, and consumers all start tightening up because of tariff uncertainty, that can have a chilling effect across the entire economy. Industries like manufacturing, tech, retail, and agriculture are especially sensitive to tariffs. Many of these sectors rely on complex global supply chains, and even small disruptions can translate to missed deadlines, thinner margins, or delayed innovation. Those factors get priced into stock valuations relatively quickly once tariffs are announced. Now, this just isn't theoretical. When President Trump rolled out broad tariffs during his first term on steel, aluminum, and Chinese imports years ago, we saw immediate market drops. But here's the important part: the market recovered. And not only that, it went on to reach new all time highs within months and years. Why? Because over the long run, markets reflect earnings, innovation, and growth, not daily headlines. Tariffs will create noise, but long term investors know that volatility is normal. Emotional investing is not. Staying the course through short term panic is what separates successful investors from reactive ones. So, what actually drives long term returns? And here's the truth: tariffs might make the market dip in the short term, but they're rarely the reason somebody fails to retire comfortably. The real drivers of long term success aren't tied to political headlines or trade disputes. They come down to discipline, consistency, and strategy. So, let's break this down. First is time in the market, not timing the market. It's tempting to think that you can outsmart the market by jumping in and out when things look scary and then jumping back in when they look safer. But history shows that missing just a handful of the best performing days in the market can drastically reduce your overall return. The markets tend to surge unexpectedly. Often right after big drops, being out of the market means missing those rebounds. The second is diversification across global companies and sectors. No one knows exactly which sectors or regions will lead the market over the next 10 to 20 years. That's why owning a globally diversified portfolio is so powerful. It protects you from being overexposed to one area and helps you capture growth wherever it happens. So this past week, as tariffs shot down, made the underlying economies drop down in value, we saw a decent rally in the bond market where investors who had some allocation to bonds were better off than investors who were 100% in an S&P 500 or equity fund. Just something to think about as you're continuing to build out a portfolio that's built for 30 or 40 years, not 3 to 4 days. The third is sticking to your plan during volatile periods. This is by far the hardest part, staying calm when everything around you feels uncertain. But that's where the biggest gains are made. Investors who stick to a well-designed plan during rough patches are the ones who come out ahead over time. It's also about habits. Automating your contributions, rebalancing when needed, and reviewing your goals regularly. None of that depends on when tariffs go up or down. The market will reward your consistency, not perfection. And while volatility may get all the headlines, it's boring, steady execution that builds real wealth. Trying to outsmart the market by jumping in and out based on news cycles almost always backfires. Missing just a handful of the best days can cut your long-term return in half. And unfortunately, those days often come right after the worst ones. That's why staying invested is one of the most underrated and powerful moves you can make. So what should you do in a market rattled by tariffs? Here's how to stay grounded and take action without making emotional decisions. First is to stay invested. Market drops often lead to major rebounds. We saw this during COVID, and we're likely to see it again in the future. And history shows that markets tend to recover faster than most people expect. Trying to jump in and out and dodge short-term losses often results in missing out on the strongest recovery days, which can permanently damage your long-term returns. Staying invested can help you capture the upside when the dust settles. Second is we want to rebalance, don't retreat. Volatility might push your portfolio out of alignment. For example, if stock drops and bonds hold steady, you might end up with a more conservative mix than you intended when you first started investing. Rather than pulling money out of the market, consider rebalancing. Selling assets that have held up well and buying into those that are undervalued. These keep your portfolio aligned with your overall goal and risk tolerance. You also want to buy quality on sale. Tariff news can temporarily depress the prices of even great companies. If your time horizon is long, a dip in price doesn't mean a dip in value. It can actually be a buying opportunity. Focus on businesses with strong cash flow, durable competitive advantages, and global reach. They're built to weather this kind of uncertainty. Next, you want to use volatility to your advantage. If you're using dollar cost averaging strategies, which is investing a fixed amount at a regular set time interval, volatility will work in your favor. You'll automatically buy more shares when prices are low, which lowers your average cost over time. If you're a more advanced investor using options or tactical strategies, volatility can open up strategic entry points. Fifth, you want to revisit your risk tolerance, not your entire plan. If volatility is keeping you up at night, it might be a sign that your portfolio isn't aligned with your comfort level, but that doesn't mean you should abandon your long-term strategy. Talk with a financial advisor about fine-tuning your allocations without overreacting. Remember, the best investors don't just survive volatility. They use it as a tool and build wealth with it, refine their strategy, and deepen their conviction. There is one caveat to all this, though, and it's to tailor this to your exact situation. An example I'm working through with one of my current clients who is buying a house next month. If their current home doesn't sell before closing, we need to dip into their IRA assets to cover purchases until they could close on their current home. When they do, we will avoid taxes on the distribution by putting that money back into the IRA within 60 days. But I want to make sure that they have enough funds available for when that happens, so we moved a chunk out of the market even though it was down, because buying a house is more important to them and they're willing to sacrifice some long-term returns because of that. So always keep in mind your overall goal when making these decisions, because your goal is what's most important. It's not always about maximizing returns, but if your goal is maximizing returns, stay invested, wait it out, rebalance your portfolio, and don't react emotionally. So there's one thing that never changes in every market environment, whether it's a bull market or bear market, inflationary or deflationary, tariff fueled or not, there's one constant. People still buy things. Cash flow from consumers to producers never stops. Regardless of headlines, we still need to eat, drive, power our homes, get medical care, and access essential services. The companies that provide those things, whether they're energy firms, food producers, utilities, or healthcare companies, continue generating revenue quarter after quarter. That's why I focus on owning high-quality businesses with strong, consistent cash flow. These are companies that have pricing power, wide economic moats, and the ability to weather both economic slowdowns and policy shifts like tariffs. They may experience short-term volatility just like the rest of the market, but over the long run, their fundamentals tend to reassert themselves. And it's those fundamentals, not short-term news cycles, that drive real wealth creation. So when headlines are screaming and volatility spikes, I always come back to this. Are the companies I still own producing, still innovating, still serving customers? If the answer is yes, then the long-term thesis is intact. Tariffs may impact prices, margins, and market sentiment temporarily, but they don't change the enduring reality that businesses exist to solve problems, meet needs, and generate value. And as long as people continue exchanging their money for goods and services with those businesses, there will be plenty of opportunity for long-term investors. So should you worry about tariffs? Not if you have a solid plan, a diversified portfolio, and a long-term mindset. Tariffs are just another headline. What matters is how you respond. If you want help building a resilient investment strategy that works in any market, volatile or not, check out the link in the description. We help investors plan for what matters most, long-term results and peace of mind. Thank you so much for watching, and I'll see you in the next video.